Good morning. Welcome to Chapter 4, Episode 1. In Chapter 4, we are talking about inventories. In other words, we're talking about companies that buy a product, mark it up, and then try to sell it at a profit. So essentially, we're talking about retail operations. In the class that comes after this one, managerial accounting or cost accounting, that's where they talk about actually building a product, manufacturing a product, but our focus in Chapter 4 is buying a product and then trying to sell it for a profit. So we're going to be talking about the inventory has to do with the product that is sitting on the shelf waiting to be sold to a customer. If you went over to Best Buy and you walked around their showroom, you would see a lot of computers out there on the shelf, and that would be part of their inventory. If you went back into the manager's office, you would also find a computer on the manager's desk. That is not part of their inventory. That would be accounted for in a separate asset account called office equipment, and it would be depreciated over time. So that's not what we're talking about. We're talking about in here the product that is on the shelf waiting to be sold to a customer. If you think about it, every example that we've dealt with so far has been companies that only provided a service to their customers. So Chapter 4 makes a big difference. We are, as I said, actually selling a product. And when you start selling a product, that kind of opens up a whole new can of worms that we have to deal with. So there are several issues that we're going to get into in Chapter 4. But first of all, we just need to understand the basic transactions and how to record them. So let me get my picture out of my way. Okay, so on the screen, you see two transactions that a shoe store has had. So Acme Shoes, they've just got into business, and they purchased 5 pair of shoes at $20 a piece. And so here they are. Here's your 5 pair of shoes. So you might just kind of think of this as being Acme's store. And then they sell 3 pair of shoes. So 3 pair of shoes are going to go out the door with a customer, and they sell those 3 pairs at $30 a piece. Now what I'd like you to do is stop the video for a second and think about how much profit has Acme Shoes made so far. Now hopefully you've come up with your answer for that. Well, let's talk about that. A lot of times students will say, well, they haven't made any profit yet. In fact, maybe they've lost $10 because they had to pay $100 for the shoes, but so far they've only got $90 back. But think about the rules of accounting. Remember that profit or net income is revenue minus expenses. Now, when you're dealing with selling a product, the revenue account, we oftentimes will just call it sales. You could call it sales revenue or just sales if you want to. Now, if you're providing a service, remember you record the revenue when you do the work. Well, when would you record revenue when you sell a product? Well, obviously, it's when that customer comes in and buys the product. We call that the point of sale. So when that customer walks out the door with that product, that's when we're going to record a sale. So far, we have had sales of $90, 3 pair of shoes at $30 a piece. So our sales has been $90. And then we're going to subtract expenses. You may recall back when we talked about the calculation of profit in Chapter 1, we said expenses, we're going to recognize expenses or record expenses when the resource expires. Or another way to think about it is we're going to match expenses to the revenues that those expenses helped us to earn or generated. So we've had revenues from 3 pairs of shoes. Now, what was the cost of those 3 pairs of shoes? Well, it was $20 a piece, or that'd be 60. So we're actually going to subtract, for expenses, we're going to subtract $60. And again, that's 3 pair at $20 a piece. And the name of this expense, we're going to call this cost of goods sold. In other words, that is the cost of the goods that were sold. And so if you take that, the sales revenue, you can think of that on a per unit basis, that's our sales price. In total, the sales revenue is going to be the total sales from everything we sold. The cost of each item, you would have a cost per unit of $20, but our total cost of goods sold is $60. And the difference between the two is $30. And we're going to call this our gross profit. In other words, it's a subtotal in the income statement. When you're selling a product, your number one expense is typically going to be the cost of that product, the cost of goods sold. So that would be the first item to be subtracted. And then a lot of times companies will have a subtotal called gross profit, and that represents the markup, the difference between what they paid for it and how much they sold it to customers for. So the 3 lines that we've built right here, that represents the first 3 lines on the income statement. Sales minus cost of goods sold is gross profit. Let's talk about these 2 transactions more from an accounting standpoint. By the way, before we do that, what about these 2 pair of shoes here that we still have? Well, the cost of those would still be in our inventory account as an asset, and it's going to stay in the inventory account until we sell it. So let's look at that, and we'll talk about how to account for these items. So I've got a journal here, and let's record these 2 transactions. In the first transaction, we would debit inventory and credit cash. So that was the purchase. When we purchase product to sell to customers, we're going to debit the inventory account for that. That's the name of the asset, or you might call it merchandise inventory. And then credit cash or credit accounts payable if you hadn't paid it yet. When you sell the product, and this is an important point, when you sell the product, there are 2 entries that you need to record. First of all, you need to record the fact that you sold it and how much you sold it for. In this case, we sold it 3 pair of shoes, $30 a piece. Our sales are $90. We're going to debit cash and credit sales revenue, or just sales. So, or you would debit accounts receivable if they hadn't paid you yet, but typically a shoe store is going to be a cash business. So the debit goes to the cash account. The sales revenue of $90 would go here. And remember that your sales is one of those temporary accounts under retained earnings. So I've just got part of the ledger represented here, the part that we're focusing on. In addition to recording the sale, you also need to record the cost of that sale. In other words, you need to record the fact that you no longer have these 3 pair of shoes. So when they go out the door, you're going to take the cost of those 3 pair, $60, out of inventory, and the debit goes to cost of goods sold. So now in the inventory account, our balance is 40, and that 40 represents these 2 pair of shoes that we still have sitting on the shelf at $20 a piece. That was our cost, $20 a piece. Now, if you look at here, the sales revenue of $90 minus the cost of goods sold, those are offsetting. Sales is a credit, because it's a plus under retained earnings. Cost of goods sold is a debit because it's a minus under retained earnings. But those two would go to the income statement. So let's just do that down here. Sales of 90 minus the cost of goods sold of 60. Again, gives us that gross profit of 30. This calculation, cost of goods sold of 60, you can summarize the calculation of that with this little formula here. And it's a very important little summary of what's happening in the inventory account. It's beginning inventory plus your purchases, that's your goods available for sale. In other words, if you take what you started with, which in this case was 0, we started with nothing. And then we added purchases of 100. So together, we had a total cost of goods available for sale to customers of $100. What you started with plus what you purchased. When all is said and done, that total goods available is either going to still be here or somewhere else. In other words, if it's not here, that means it's gone out the door. So we can count what we still have. In fact, some of y'all may have been involved in taking an inventory at some store or some place where you've worked. When you take an inventory, you actually go out there and count it. Like here, we would count 1, 2. We still have these 2 pair of shoes in inventory. And at $20 a piece, that's $40. That's the 40 that's in our inventory account. So it's like we're double checking our accounting records too, that 40. But if you subtract that 40 ending inventory, that gives you the cost of goods sold, and that's what we subtracted from sales on the income statement. So in just a minute, we're going to be doing some practice problems where we just go through these 2 calculations. So the first first stage of understanding in Chapter 4 is what is cost of goods sold, how do you calculate cost of goods sold, and what is gross profit, and how do you calculate that. So we're going to go through these 2 calculations. One final thing, too. Anytime you're selling a product, your ability to make a profit depends on where you set your price. And if your product is in high demand and people really want it, you might be able to put a larger markup into the price. As competition comes in and you have to compete for that market demand, you may have to lower your prices. So one thing that companies will monitor very closely is how much of their sales price actually represents that markup, that profit. So we will monitor that with what's called the gross profit percentage. So to get that, we're going to take, it's calculated as the gross profit divided by your sales. So we're going to take the $30 and divide by the sales, and that's going to be 1/3 or 33.33%. Another way to think about it is that your sales represents 100% of sales, of course. Let me put this down as percentages here. Your cost of goods sold in this example represents 67% of your sales, and your cost of goods sold represents the other third. Let me add a digit to this so we can kind of see the. So again, that gross profit percentage that we calculated here, if you want to think of it as the gross profit represents one piece of that sales price, and the cost of goods sold represents the other part of it. So in this case, the cost is 2/3 of the sales price, or the sales, and the gross profit is that other third. Okay, so what I'd like you to do is think about how you would apply this approach into, let me just say it. Okay, I was having trouble getting over to the next page. So what I've got here is a scenario where somebody is opening up a t-shirt business. And they open up in year one, 20x1, and then they operate for 4 years. And so what I'd like you to do is go through these 4 years, fill in the spaces down here with the information that I give you, and then, using your understanding, find the missing pieces. So I'm going to go ahead and do year one. Although if you want to try it on your own, stop the video first. And then after we do year one, you might stop the video and try to do year two, and just kind of stop and start as you go through this. That's the way I would do it if I was in front of you in class. So in year one, Terry opened up Terry's T-Shirt Express at the beginning of 20x1. And during her first year of operations, she purchased a total of $300 of t-shirts. So in year one, we had $0 to start with, but then we purchased $300 of t-shirts. And so when you add those two together, our goods available for sale is $300. That's the total cost of everything we had available for sale to customers. Now, of course, it wasn't all there at one time. Hopefully, we're kind of buying and selling day by day, but we're just kind of summarizing for the entire year here at the end. It says at the end, we still had $60 of t-shirts in the ending inventory. So we would subtract that 60, and we have $240 as our cost of goods sold. Well, that $240 comes down here, and we're going to subtract that cost of goods sold from whatever our sales is. And it says in the paragraph that sales for 20x1 total $320. So $320 is our sales, subtract $240, and we would have a gross profit, a difference there of $80, and our gross profit percentage would be 80 divided by 320, and so that's going to be a fourth. It's going to be equal to 80 divided by the 320, and that would be 25%. Okay, now with that as an example, what you might do is stop the video and try year two. So now we'll do year two together. In year two, our beginning inventory is whatever we ended year one with. So ending inventory was 60, so that would be our beginning inventory in year two. And then in the paragraph it says we purchased a total of 430 t-shirts, so we'll add that. So we know that our goods available for sale is going to be 490, the beginning inventory plus our purchases. Sales during 20x2 is 480. Okay, so we'll come down here. 480 is our sales. And the cost of t-shirts sold is 300. So on the income statement, we would take 480 minus 300, and that gives us a gross profit of 180. 480 minus the 300. Let's go back up here. So what was our ending inventory? Well, we know that our cost of goods sold was 300. So let's put that up here, 300. And now 490 minus something leaves 300, and we would solve for that. And the ending inventory then was 190. So go through it and kind of double check your math and see that it came out right. Finally, the gross profit percentage, remember, is equal to our gross profit of 180 divided by our sales of 480, and our gross profit percentage is 37.5%. So think about this a second. In the first year, our gross profit was 25% of sales. In the second year, it's 37.5%. What could cause that to happen? I mean, it is true that sales went up, but that doesn't necessarily, if our gross profit, if we didn't do anything to sales prices, whether sales went up or down, the gross profit would still be 25% of sales. So if the gross profit percentage is changing, that means that we're doing something with our sales prices. So in this case, it looks like we're raising our prices, creating more of a difference between the cost and the sales, and that's what that gross profit percentage is measuring. Okay, in the third year, I throw a little bit of a twist into the paragraph. So stop the video and try year 3, and then come back and I'll do it with you. Okay, so in year 3, it says that we purchased during 20X3 a total of $600 of t-shirts, and the balance of the t-shirt inventory was 70 at the end. Okay, so let's see. In 20X3, we purchased 600. I'll put that there. Now what we started with, of course, is whatever we ended year 2 with, which was 190. So the beginning inventory plus the purchases of 600 means that our goods available for sale is 790. That's the total that we had available for sale to customers. At the end of the year, we have 70 left. So let's subtract 70, and that gives us 720. Okay? So, it says this ending balance is lower than Terry expected, and she suspects some of her inventory has been stolen. Well, let's see. How would we figure that out? Her sales during 20X3 totaled 640. Okay, so let's put in the sales here. 640. And she knows her sales price includes a gross profit of 25%. Okay, now remember, Terry is the owner of the store. She's the one who sets the sales price. So she knows she has put the price to include a 25% markup, 25% gross profit. So we could factor that in to figure out what inventory should have been. Before I do that, think about this. In our calculation up above, we calculated cost of goods sold to be 720. Well, if we subtracted the 720 from the 640, well, that's going to give us a negative gross profit. That would be like buying something for $10 and selling it for $6. It's hard to make a profit that way. And Terry knows that she's not doing that. She knows that she is selling the t-shirts to include a 25% gross profit. So that's how she would know something funny is going on. So let's do this. Let's use what we know and back into what inventory should have been. So our gross profit percentage should be 25%. So if the gross profit was 25%, that means the gross profit should have been 25% of the sales. That would be 160. That means that the cost of goods sold would have been the difference between those two. Or another way to look at it, if the gross profit is 25%, put these down as percentages here. If the gross profit is 25%, that means that the cost of goods sold has to be the other 75%, because in total, the sales, of course, is equal to 100% of the sales. So either way you can calculate the difference between these two dollar amounts, or take 75% of the sales. Either way you do it, the cost of goods sold, I'm going to subtract backwards so that I have a negative number if it'll let me. Maybe not. Cost of goods sold is 480. Put a negative sign on that. Again, 640 minus 480 is 160. And so if the cost of goods sold was 480, let's take that up here. And remember, we know what the goods available for sale was, 790. So what the inventory should have been is the difference between those two. So the difference between 790 and the 480 is 310. And I'll put a negative sign on that. So that's what our inventory should have been. So it looks like we are missing quite a bit. In fact, the difference between the 310 that it should have been and the 70, remember this is what she actually has on hand. The difference between those two, the missing amount, let me calculate that here. The missing inventory is the difference between the 310 and the 70, which would be 240. So that's how much inventory we are missing. So that's inventory that didn't walk out with a paying customer, it just walked out, or it's lost or something. We call, anytime you have unexplained losses of inventory, that's called inventory shrink. And we will talk more about that in a couple of videos. For right now, I just want to kind of throw that in there for funsies. For right now, as you go through the unless I say differently, let's just assume that we're not missing anything unless I throw that in, as a potential feature. Okay, let's do one more. Go to year 4. Sales in year 4 total 780. So let's put that down here. Sales are 780. And the gross profit is equal to 30% of the cost of goods sold. Now, I threw this in there for funsies too. Usually, I give you the gross profit as a percentage of sales, but in this one, I said that the gross profit is 30% of the cost of goods sold. So, 30% of cost of goods sold, that's what the gross profit is. Well, we don't know what our cost of goods sold is, so we'll have to come back to that. Let's see, purchases during the year are 900. Okay, so we're 900. Now, how much was our beginning inventory? Remember last year, year 3, that's when we had that stolen amount. Would our beginning inventory be the inventory that we should have had or the inventory that we do have? Of course, it would be what we actually have, be 70. So we'll put that down as our beginning inventory. Add that to the 900 of purchases, and our goods available for sale in year 4 is 970. Now we need to figure out what was our ending inventory, what was our cost of goods sold, and down here we know our gross profit is 30% of cost of goods sold, but we don't even know that. So, have I given you enough information to do this? In class, the entire class would be shaking their heads no, that we haven't, but the answer is yes, I have. So what you might do, and again, I just kind of threw this in for a twist, pause the video, see if you can solve this, and now I'll work it for you. What we're saying here is that whatever cost of goods sold is, let's call that C. Whatever that is, we know that the gross profit is 0.3 C, 30% of C. And we don't know either one of those, but remember that C, that means there is an understood 1 in front of that C. And we know that both of these added together would be equal to our sales. Because sales minus cost of goods sold is gross profit. So we can add up. That means in terms of C, the sales is equal to 1.3 C. So if I gave you an algebra problem and it said 780 equals 1.3 C, could you solve for C? And sure you could. So you would take 780 divided by 1.3, and that would be C. So 780 divided by 1.3, I'll do it right here. 780 divided by 1.3 is 600. That means that our cost of goods sold is 600. I'm going to subtract that, and getting down to our gross profit of 180. Now be sure and double check that. Is 180 30% of 600? And yes, it is. It checks out. So always go back and double check things. So if our cost of goods sold was 600, we'll put that up here. And that means that our ending inventory at the end of the year there would be equal to the difference between 970 and 600, which would be 370. And again, I'm going to put a negative sign so I can be subtracting. So, in the exam, I'll be testing you over, can you calculate cost of goods sold? Can you calculate gross profit? And do you understand how to use the gross profit percentage? So there are some homework problems that zero in on this, and I would urge you to practice those and really understand these simple calculations before moving on to the next stage of Chapter 4. And remember that the big picture is this calculation of cost of goods sold is summarizing what's happening in the inventory account. What you started with plus what you purchased is the total inventory you had available. At the end of the period, you either still have it or it's gone out the door. It's somewhere else. So if you subtract what you still have, that will give you your cost of goods sold, and that's what you subtract from sales to get your gross profit. Okay, that's the end of episode 1.